Sarah Thompson woke up on October 2nd, 2024, opened her Bank of America mobile app like she does every morning, and saw something that made her heart stop. $0. Her checking account showed zero. Her savings account showed zero. Every single account she had was completely empty. Not a dollar, not a cent, nothing. And she wasn't alone. 20,000 other customers across America were staring at the exact same nightmare on their phones that Wednesday morning. Some were at the grocery store, cards declined, others were trying to pay rent. Parents couldn't buy formula for their babies. And for 12 straight hours, Bank of America said almost nothing except that they were aware some clients were experiencing an issue. Now, fast forward to May 2nd, 2025. It's a Friday morning, and suddenly millions of people can't send money through Zelle. They can't make debit card purchases. Direct deposits aren't showing up. ATM withdrawals are failing. What happened? Fiserv, the company that processes transactions for Bank of America, Capital One, TD Bank, Navy Federal Credit Union, Ally Bank, and 20 other major institutions, had what they called an internal issue. For 12 hours, 60 different banking applications went dark simultaneously. People were locked out of their own money across multiple banks at the exact same time, and this is the part that should terrify you. Nobody could do anything about it except wait. But here's what nobody's telling you. This isn't about isolated technical problems. This is about a fundamental vulnerability in how American banking actually works in 2026, and the risks are accelerating faster than the solutions. Over the next several minutes, I'm going to show you exactly what's happening behind the scenes of these glitches, why they're becoming more frequent, what it means when a single company can freeze millions of accounts across dozens of banks, how new anti-fraud rules are accidentally locking legitimate customers out of their own money, and most importantly, what you can actually do to protect yourself starting today. This isn't fear-mongering. This is verified information from regulatory filings, bank disclosures, and documented incidents that you need to understand because your money is more vulnerable than you think. Let's start with what a bank glitch actually is, because the term gets thrown around loosely and that masks what's really happening. When Bank of America customers saw zero balances in October 2024, that wasn't money disappearing. It was a display error in the system that shows account information. The money was still there in the bank's core systems, but the interface that customers used to access information about their money was broken. For 12 hours, people couldn't see what they had, couldn't verify if paychecks had deposited, couldn't know if automatic payments would clear. The psychological impact was immediate and severe. One account holder described it as heart-stopping, thinking her entire life savings had vanished. But contrast that with what happened in May 2025 during the Fiserv outage. This wasn't just a display problem. This was the actual transaction processing infrastructure failing. Fiserv runs what's called the plumbing of banking. When you swipe your debit card, Fiserv routes that transaction. When you send money through Zelle, Fiserv processes it. When your employer sends you a direct deposit, it moves through Fiserv's systems. And Fiserv doesn't just serve a handful of banks. They serve over 10,000 financial institutions across America. So when Fiserv has an internal issue like they did on May 2nd, the impact isn't limited to one bank's customers. It cascades across the entire ecosystem simultaneously. Here's the crucial detail that most people don't understand. Fiserv isn't owned by these banks. It's a third-party vendor. Banks outsource their core processing to companies like Fiserv, FIS, and Jack Henry, because building and maintaining that infrastructure themselves is incredibly expensive. But that creates what's called vendor concentration risk. When too many institutions rely on the same provider, a single point of failure can bring down a massive portion of the banking system at once. And right now in 2026, we have exactly that scenario. The three biggest banking technology providers handle transactions for thousands of financial institutions. And when any one of them has problems, millions of people lose access to their money simultaneously. So the first major risk you need to understand is systemic dependence on centralized infrastructure. Your bank might be perfectly healthy with plenty of capital and sound lending practices, but if their technology vendor goes down, you're locked out regardless. And the frequency of these incidents is increasing, not decreasing. In 2023, we saw the Bank of Oklahoma outage that affected 26 different banks when their service provider failed. In 2024, the Bank of America zero balance glitch. In 2025, the Fiserv outage affecting millions across multiple major institutions. And now in 2026, we're seeing even more sophisticated problems emerging. One of the newest issues affecting customers in 2026 is what the financial industry calls enhanced fraud prevention. But what customers experience is being randomly locked out of legitimate transactions. Here's how it works. Banks are using artificial intelligence to monitor transaction patterns in real time, looking for anomalies that might indicate fraud or money laundering. In theory, this protects customers. In practice, it's creating a nightmare for normal people trying to access their own money. The AI algorithms flag transactions as suspicious based on factors like transaction size, frequency, device fingerprints, location data, and behavioral patterns. But the systems are overly sensitive and frequently wrong. Let me give you a real example. In January 2026, a new rule from FINRA, the Financial Industry Regulatory Authority, went into effect called Rule 2166. This allows banks to hold wire transfers and large transactions for up to 5 business days if their systems flag the transaction as potentially fraudulent. The stated goal is protecting seniors from scams and preventing money laundering. But here's what's actually happening. AI systems are blocking legitimate purchases because someone is buying something slightly more expensive than usual, or they're using a new device, or they're traveling and trying to make a purchase from a different location. And when the transaction gets flagged, you can't just call and fix it immediately. Under the new rules, the bank can hold your money for days while they investigate. Seniors are being hit particularly hard. Many older Americans don't use their accounts the same way younger people do. They might write checks instead of using debit cards. They might make larger withdrawals for cash because they don't trust electronic payments. And all of that looks anomalous to an AI system trained on typical spending patterns. So the algorithm flags it, the transaction gets blocked, and suddenly, someone trying to pay their contractor or buy a car or send money to a grandchild is stuck in a multi-day review process. There's no override button. There's no way to prove it's legitimate and get instant access. You wait, sometimes for a full week, while the bank decides whether to let you use your own money. Now combine that with another trend happening in 2026, the reduction of physical bank branches and in-person banking services. Over the past 5 years, major banks have been converting traditional branches into what they call advisory centers. These locations don't have teller windows, they don't keep cash on hand. They're designed for financial planning appointments, not daily transactions. If you need to deposit a check or withdraw cash, you're directed to ATMs or mobile deposit. And if something goes wrong with your account, if you get locked out or flagged by the fraud system, you can't just walk into a branch and talk to someone who can help immediately. You have to call a national customer service line, wait on hold, and hope whoever answers has both the authority and ability to resolve your problem. This matters because when glitches happen, when systems go down, when accounts get frozen, the ability to speak with someone in person who can actually do something about it is disappearing. During the Fiserv outage in May 2025, customer service lines were overwhelmed, wait times exceeded 2 hours, and the representatives who finally answered couldn't do anything except apologize and say the technical team was working on it. Nobody had a timeline. Nobody could manually process transactions. The entire system was down, so everyone just waited. But there's an even deeper problem brewing, and it involves cybersecurity. 2025 was a devastating year for banking data breaches, and the trajectory for 2026 is even worse. According to exclusive research from American Banker, 52% of banking executives predict that cybersecurity attacks will worsen in 2026, and another 43% say this shift will probably happen. That means 95% of banking professionals expect cyber threats to intensify this year, and they have good reason for concern. In 2025, there were 7 major data breaches affecting the banking and financial services industry directly. The largest involved Prosper Marketplace, a peer-to-peer lending platform where 13.1 million customer accounts were compromised. But even more concerning was the breach at Marquee Software Solutions in August. Marquee provides anti-money laundering and compliance services to financial institutions. They're not a bank themselves, they're a vendor that banks use. And when hackers breached Marcus systems, they gained access to sensitive information for 824,000 customers across at least 80 different banks and credit unions. Names, social security numbers, dates of birth, account information, all stolen in a single attack on a third-party vendor. This illustrates another critical vulnerability. It's not just the banks themselves getting hacked. It's the entire supply chain of companies that provide services to banks. And because banks share customer data with these vendors for legitimate business purposes like fraud prevention and compliance, a breach at any one vendor can expose information from dozens of financial institutions simultaneously. You might choose to bank with an institution that has excellent cybersecurity, but if that bank uses a vendor with weak defenses, your information is still at risk. The sophistication of these attacks is also escalating dramatically. Cybercriminals are now using artificial intelligence to create phishing emails and text messages that are nearly indistinguishable from legitimate communications from your bank. They can generate fake websites that look exactly like your bank's actual site. They can even use AI to clone voices, calling and pretending to be a bank representative to trick you into revealing security codes or passwords. In 2025, the financial services industry saw a 43% increase in ransomware attacks compared to 2024. And in several documented cases, including one affecting the Iranian banking system in 2024, institutions actually paid ransoms to criminal groups to regain control of their systems. So cybersecurity isn't just about whether your account information gets stolen, it's about whether the bank's core systems can actually function when under attack. And right now in 2026, the evidence suggests that many institutions are not adequately prepared. When Marquis software was breached, affected banks had to notify hundreds of thousands of customers that their personal information was compromised. Those customers now face years of potential identity theft risk. Credit cards opened in their names, tax returns filed fraudulently, loans taken out without their knowledge. And while the banks offer credit monitoring services as compensation, that doesn't actually prevent the fraud. It just alerts you after it happens, so you can spend months or years cleaning up the mess. Now let's talk about what happens when you actually can't access your money, because this is where theory meets reality. During the Fiserv outage, direct deposits didn't post when they were supposed to. People were expecting paychecks that Friday and they didn't appear in accounts until late that night or the following Monday. For someone living paycheck to paycheck, that delay can mean bounced rent checks, overdraft fees on other accounts, or not being able to buy groceries. And legally, there's almost nothing you can do about it. The banks aren't stealing your money, the money exists, but if the system that allows you to access it is broken, you're powerless until it gets fixed. This is fundamentally different from how cash works. If you have physical cash in your possession, you can spend it regardless of whether any bank's computer systems are functioning. It's immediate, tangible, and doesn't depend on networks or vendors or processing systems. But in 2026, most Americans have very little physical cash. Everything is digital, stored in accounts, accessed through cards and apps and electronic transfers. And that creates total dependence on those systems working properly. When they don't, when there's a glitch or an outage or a cyber attack, you have no backup plan unless you've prepared in advance. Let me give you some specific examples of how real people protect themselves from these risks, because this isn't theoretical. These are practical steps that financially savvy individuals are taking right now in 2026. First, they don't keep all their money at a single institution. If you have checking, savings, and investment accounts all at the same bank, you're completely vulnerable if that bank or its vendor has problems. Spreading your money across multiple banks means that if one goes down, you still have access to funds elsewhere. It's inconvenient to manage multiple accounts, but that inconvenience is insurance against being completely locked out. Second, they maintain relationships with both large national banks and smaller credit unions. Big banks have massive resources and extensive ATM networks, but they also tend to have more complex technology infrastructures with more vendor dependencies, which means more potential points of failure. Credit unions are smaller, often locally operated, and sometimes use different technology providers than the major banks. Having accounts at both types of institutions provides diversification against systemic tech failures. If a Fiserv outage takes down all the major banks, your credit union running on a different system might still be operational. Third, they keep a modest amount of physical cash accessible at home. Not thousands of dollars, but enough to cover a week or two of essential expenses if electronic banking becomes unavailable. Financial advisors typically recommend keeping between $500 and $2,000 in cash, depending on your household size and expenses. Store it securely, obviously. But having that buffer means you're not completely helpless if there's an extended outage or if your accounts get frozen during a fraud investigation. Fourth, they use high-yield savings accounts at online-only banks as an additional backup. Banks like Ally, Marcus, by Goldman Sachs, Alliant Credit Union, and Discover offer savings accounts with interest rates significantly higher than traditional brick-and-mortar banks, often above 4% as of early 2026. These online banks operate on different technology platforms than the major retail banks, so they provide an additional diversification. Plus, earning 4% on your emergency fund instead of 0.1% makes a real difference over time. Fifth, they monitor their accounts religiously and set up alerts for any unusual activity. Most banks allow you to receive text or email notifications whenever transactions above a certain amount occur, whenever a purchase is made in a new location, or whenever your balance drops below a threshold you set. These alerts let you catch problems immediately instead of discovering weeks later that something went wrong. And if you do notice unauthorized transactions, report them instantly. Under federal law, your liability for fraudulent charges is limited if you report them within 60 days, but the protection decreases the longer you wait. Sixth, they use strong, unique passwords for every financial account and enable two-factor authentication everywhere it's offered. This sounds basic, but most people still reuse the same passwords across multiple sites, which means if one site gets breached and your password is stolen, criminals can try that same password on your bank account. Password managers like Bitwarden or LastPass can generate and store complex, unique passwords for every site, so you don't have to remember them all. And two-factor authentication, where you receive a code on your phone in addition to entering your password, dramatically reduces the risk of unauthorized access even if someone steals your password. Now let's talk about alternatives to traditional banking, because the vulnerabilities I've described aren't going away. If anything, they're increasing as banks become more dependent on technology and more interconnected with vendors and third-party providers. So what are your other options? One increasingly popular choice is credit unions. Credit unions are member-owned nonprofits that typically offer the same services as banks' checking accounts, savings accounts, loans, credit cards, but with a different structure. Because they're nonprofits, they often have lower fees and better interest rates than for-profit banks. And because they're smaller and more locally focused, they may use different technology providers, which gives you diversification against the vendor risks that affect large national banks. Alliant Credit Union, for example, is easy for anyone to join despite technically being a credit union with membership requirements. You can become a member by donating $5 to the Alliant Credit Union Foundation, and the credit union itself often pays that donation for you. They offer high-yield savings accounts currently earning about 3%, which is competitive with the best online banks. Consumers Credit Union offers an even more attractive rewards. Checking account that pays up to 5% on balances up to $10,000. That's extraordinary compared to traditional big banks that pay almost nothing on checking accounts. Navy Federal Credit Union serves military members, veterans, and Department of Defense employees and has over 340 branches across 31 states. Pentagon Federal Credit Union, known as PenFed, also focuses on military and government employees, but has open membership to virtually anyone. Both institutions offer full-service banking with lower fees than most commercial banks. And because they serve specific communities, they tend to have more personalized service and better responsiveness when problems occur. Another alternative is online-only banks. These institutions don't have physical branches, which allows them to operate with lower overhead costs and pass those savings to customers through higher interest rates and lower fees. Ally Bank, for instance, has completely eliminated overdraft fees and offers checking accounts with no monthly maintenance fees and no minimum balance requirements. Their savings accounts currently pay around 4% interest, and they reimburse ATM fees if you have to use an out-of-network machine. Marcus, by Goldman Sachs, offers similar rates on savings accounts and certificates of deposit with no fees and no minimums. The trade-off with online banks is that you can't walk into a branch if you need help. Everything is done through apps, websites, and phone support. For people comfortable with technology, that's not a problem. For those who prefer face-to-face interaction, especially seniors, it can be a significant drawback. But, as I mentioned earlier, even traditional banks are moving away from full-service branches, so the difference between online-only banks and traditional banks is shrinking in terms of in-person support. One more option worth mentioning is diversifying beyond just banks. Some people are keeping portions of their savings in Treasury bills directly purchased from the U.S. government through Treasury Direct. Treasury bills are short-term securities backed by the full faith and credit of the United States government, making them arguably safer than bank deposits, and the interest is exempt from state and local taxes. As of February 2026, 6-month Treasury bills are yielding around 4.5%. You can buy them with no fees directly from the government, and they provide complete independence from the banking system. If every bank in America had a simultaneous technology failure, your Treasury bills would still be safe, because they're not connected to that infrastructure. Similarly, some people allocate a small percentage of savings into physical precious metals like gold and silver. This isn't about expecting economic collapse or the dollar becoming worthless. It's about having tangible assets that hold value independently of digital banking systems. If there's an extended period where electronic banking is disrupted due to cyber attacks or infrastructure failures, precious metals can be sold or traded for cash in local markets. Obviously, this comes with its own risks. Storage and security are concerns. Liquidity is limited compared to a bank account. But as a small portion of a diversified strategy, physical assets provide protection against scenarios where digital systems fail. Now, I want to address the comparison with what's happening in Iran, because the scale of banking crisis there illustrates just how bad things can get when systemic problems compound. In late January 2026, the Iranian rial crashed to 1.5 million per US dollar, marking a 70% loss of value in just 12 months. But the currency collapse is only part of the story. The banking system itself is disintegrating. Iranians can only withdraw 30 to 50 million rials per day from bank branches, which sounds like a lot until you realize that's only 18 to 30 US dollars. ATM limits are even worse at 3 million rials per transaction, less than $2. But here's the truly catastrophic part. In October 2025, Allende Bank, one of Iran's major institutions with 7 million customers, completely collapsed. The central bank called it effectively a Ponzi scheme. The bank had $7 billion in debt and was merged into Bank Melli in a desperate attempt to prevent total systemic failure. And it's not just one bank. In January 2026, 5 additional major Iranian banks are on the verge of collapse, including Sepa Bank, which is controlled by the Revolutionary Guard and is one of the 3 largest banks in the country. When institutions that size fail in a country already facing currency collapse and international sanctions, the result is economic catastrophe. Iranians can't access their own money not because of technical glitches, but because the money itself is worthless and the banks don't have enough physical currency to distribute. The largest Iranian banknote is 2 million reals, which has a value of about $1.20. Imagine trying to withdraw a meaningful amount of money when the largest bill is worth barely more than $1. You'd need a suitcase full of cash just to have a few $100s worth of value. The banking system has essentially ceased functioning for ordinary transactions, and people have resorted to bartering, using foreign currency on black markets, and relying on informal lending networks within families and communities. This is an extreme example far beyond what's happening in America. But it illustrates the endpoint of banking system failure. It doesn't happen all at once. It's a gradual degradation where first there are glitches and delays, then there are withdrawal limits, then confidence erodes, then banks fail, then the currency collapses, and suddenly an entire population can't access the money they worked for and saved. America is nowhere near that scenario. U.S. banks remain well capitalized, the dollar is stable, and regulatory oversight is strong. But the lesson from Iran is that banking crises accelerate faster than most people expect. And once confidence starts breaking, the deterioration can be rapid and irreversible. So, what should you actually do with this information? Let me give you a practical action plan you can implement this week. Step 1. Assess how much money you have at each financial institution and whether it exceeds FDIC insurance limits. The FDIC insures deposits up to $250,000 per depositor per bank. If you're married, you can structure accounts to get $500,000 in coverage at a single bank by having separate individual accounts plus a joint account. But if you have more than the insured amount at any one institution, you're taking unnecessary risk. Move the excess to other banks immediately. This isn't about predicting which bank will fail. It's about ensuring that if any bank fails, you're fully protected. Step 2, open accounts at least 2 different types of institutions. Have one account at a major national bank for convenience and ATM access. Have another at a credit union or online bank that uses different technology infrastructure. This way, if one system goes down, you still have access to funds elsewhere. It takes an afternoon to open these accounts online, and the peace of mind is worth the minor inconvenience of managing multiple relationships. Step 3, set up account alerts so you're immediately notified of any unusual activity. Log into your banking apps or websites and configure alerts for large transactions, international purchases, low balances, and failed login attempts. These notifications let you catch problems when they're small instead of discovering major issues weeks later. Step 4. Enable 2-factor authentication on every financial account. Even if your password gets stolen in a data breach, 2-factor authentication prevents unauthorized access because the thief would also need physical access to your phone to receive the security code. This single step eliminates the vast majority of account takeover risk. Step 5. Review your passwords and make sure you're not reusing the same ones across different sites. If managing multiple unique passwords seems overwhelming, invest $20 a year in a password manager that generates and stores them for you. This is basic digital hygiene that most people neglect until after they've been hacked. Step 6. Keep some physical cash at home for emergencies. Not your entire life savings, but enough to cover essential expenses for a week or 2 if electronic banking becomes unavailable. Store it somewhere secure, tell your spouse or trusted family member where it is, and treat it as emergency insurance you hope to never use. Step 7. Consider shifting some savings into treasury bills or money market accounts as an alternative to keeping everything in traditional bank accounts. These provide diversification away from the commercial banking system while still offering safety and liquidity. You can buy treasury bills directly from Treasury Direct with no fees, and many brokerage firms offer money market funds that are just as safe as bank deposits with comparable or better yields. And finally, Step 8, stay informed about developments affecting your financial institutions. When you hear news about data breaches or service outages or new regulations, pay attention to whether your banks are affected. Don't panic, but do assess whether you need to take protective action. Knowledge is the first line of defense against financial risks, and being proactive rather than reactive can prevent small problems from becoming major crises. The era of completely safe, completely reliable banking is a myth that technology has exposed. Every system has vulnerabilities. Every network has potential points of failure. Every institution depends on vendors and providers and infrastructure that can break. That doesn't mean you should lose faith in the banking system entirely or withdraw all your money and keep it under a mattress. It means you should understand the specific risks, take reasonable precautions to protect yourself, and maintain enough diversification that no single failure can devastate your financial life. The glitches happening in 2026, the frozen accounts, the data breaches, the systemic outages affecting millions simultaneously, these aren't anomalies. They're symptoms of a financial infrastructure built for the 20th century, trying to operate at 21st century scale and speed. And until the fundamental architecture changes, until banks reduce their dependence on centralized vendors, until cybersecurity improves dramatically, until regulatory frameworks catch up with technological realities, these problems will continue and likely worsen. Sarah Thompson, the Bank of America customer who saw zero balances that October morning, eventually got access to her accounts again. The glitch was fixed. Her money was still there. She didn't lose anything except 12 hours of stress and uncertainty. But she made a decision after that experience. She opened accounts at 2 other banks, set up alerts on all her accounts, started keeping $1,000 in cash at home, and moved her emergency fund to a high-yield savings account at an online bank that uses completely different technology systems than Bank of America. She doesn't trust that it won't happen again. And frankly, based on everything we've seen, she's right not to. The question isn't whether your bank will experience another glitch or outage or breach. The question is what you'll have in place when it happens so that you're inconvenienced rather than devastated. Because in 2026, your money is only as accessible as the technology systems that connect you to it, and those systems are more fragile than anyone wants to admit. Let me share one more critical piece of information that ties all of this together, and it's something that happened just weeks ago in early 2026 that didn't get nearly enough attention. Metropolitan Capital Bank and Trust in Chicago became the first U.S. bank failure of 2026 on January 30th. The FDIC stepped in immediately, arranged for another institution to assume the deposits, and every customer had full access to their money the next business day. This is exactly how the system is supposed to work when a bank fails. Depositors are protected up to the insurance limits, and life goes on with minimal disruption. But notice what didn't happen. There was no technology failure, there was no vendor outage, there was no cyber attack. This was an old-fashioned bank failure where the institution ran out of capital and couldn't meet its obligations. The FDIC handled it efficiently using processes refined over decades of bank supervision. The problem is that the FDIC's playbook was built for capital problems, not technology problems. They know how to handle a bank that made bad loans or lost money on investments. They don't have a perfect solution for what happens when a Fiserv outage locks millions of customers out of accounts across dozens of healthy banks simultaneously. This is the disconnect that makes the current moment so precarious. The regulatory framework protecting depositors was designed for the risks of traditional banking. Capital adequacy requirements ensure banks can withstand losses. Deposit insurance protects customers when banks fail. Regular examinations catch problems before they become catastrophic. All of these safeguards work well for the risks they were designed to address. But they weren't designed for supply chain vulnerabilities where a single vendor serves thousands of institutions. They weren't designed for AI systems that incorrectly flag legitimate transactions and freeze accounts. They weren't designed for ransomware attacks that can paralyze an entire bank's operations for days. There's a reason why 52% of banking executives predict cybersecurity will worsen in 2026. They understand what's coming better than anyone because they see the threat intelligence reports, the attempted intrusions, the sophistication of attacks that get blocked, and they know the defenses aren't keeping pace with the threats. When Marquis Software, a vendor nobody outside the banking industry has heard of, gets breached and 824,000 customer records from 80 different institutions are stolen, that reveals how interconnected and vulnerable the whole ecosystem has become. And it's not just about the banks you've heard of. Community banks and regional institutions face even greater challenges because they have smaller technology budgets and fewer specialized cybersecurity staff. When a major bank like JP Chase or Bank of America gets attacked, they have entire teams of security experts and can afford cutting-edge defenses. A small community bank in rural America might have one IT person handling everything from printer problems to cybersecurity. They're dependent on their technology vendors to provide security, and if those vendors get compromised, the community bank has almost no way to protect itself independently. This creates a situation where the safety of your money might have less to do with which bank you choose and more to do with which vendors that bank uses, and you have no visibility into those relationships. You can research a bank's capital ratios, read their financial statements, look up their FDIC ratings, but you can't easily determine which specific technology vendors they use or assess whether those vendors have adequate security. And even if you could, as a regular customer, you have no power to demand changes.